Take it easy. Central bank turns loosen financial conditions, rate cut bets and rallying equity and bond markets are feeding into a gradual loosening of financial market conditions that could potentially send world growth ticking higher by the end of the year, a closely watched index suggests. For an interactive version of the chart, click tmsnrt.rs. Since June, financial conditions have been easing, and in the United States they are back where they were at the start of the fourth quarter, said Sven Jari Stehn, head of Europe economics at Goldman Sachs. The dollar, another key determinant of global financial conditions, has also slipped off two-year highs hit in May. They have a strong historical correlation with economic growth, according to Goldman, which says that a 100 basis point tightening in conditions tends to crimp growth by around 1 percentage point over the coming year and vice versa. Tight conditions following December's equity sell-off and trade war noise hurt world growth early in 2019, but Stehn said recent loosening could help bring about a recovery if central banks deliver the stimulus markets expect. The negative effect is diminishing, and towards the end of the year it should turn into a boost for U.S. growth. He said the Fed is expected to cut rates by 25 basis points at its meeting in late July, and a September rate cut from the app is priced in by markets. Just how much more money could central banks pump into world markets? Pictet fund manager Steve Don says current 3,000-point levels on the SP 500 imply up to $1.07 trillion more will be injected by the biggest central banks, the Fed, Bank of England, People's Bank of China, and Bank of Japan. The first step will be the Fed ending its balance sheet normalization at the end of September. So far, it has allowed its bond holdings to fall by as much as $50 billion a month. Don's estimates the current liquidity flow from the big five central banks at 8.6 of global debt versus a 10.4 average since the crisis, but the upcoming Fed balance sheet shift should raise it to 9.6. Last year, you had a relentless liquidity squeeze, which culminated in the capitulation of the Fed and China, Don said. It's an illustration of the Powell put. Basically, they are saying we are intervening to make sure liquidity levels don't fall anymore.